Abolition of the prime lending rate, PLR, and its replacement with the repo rate. While this is a South African policy discussion, it could have direct implications for Eswatini as a member of the Common Monetary Area, with the Lilangeni pegged to the South African rand. Monetary policy decisions in South Africa could have an immediate impact on Eswatini's financial system. If the prime lending rate is scraped in South Africa, will banks in Eswatini need to adjust how they price loans? Could this also affect borrowing costs for households, businesses and mortgage holders, while also potentially improving transparency in how interest rates are set? We are now joined by economist Anele Sibia to unpack this potential shift. Mr. Sibia, thank you very much for your time. At its core, what really is the real significance of the SARB's proposal to abolish the prime lending rate?
Thank you, Notile. Good afternoon to you, and also good afternoon to the viewer. So what we are seeing here is a white paper. I think I like the fact that you've used the word potentially. So what this says is doing is, before we used to price loans at, the repo rate plus a certain margin, which would then call the prime, which would then give us the prime lending rate. So what now this is going to do is we are just going to have a clearer direction in terms of how much the interest rate is going to be. So it's just going to be the repo rate, the bank rate, basically. So that now adjusts with international standards in terms of how, we look at the valuations of loans globally and also in the region.
This proposal, Mrs. Sibia, is there a reason why it's coming in now?
I think not till there is a couple of reasons, right? I mean, first up, we've seen the South African Reserve Bank, tabling a proposal last year, which then came into law, I think, in September, October, where we saw the threshold, the inflation target being reduced from the lower bound of 3% to the high bound of 6% to a 3% point now, and with a 1 percentage point margin, so it's like between 2 to 4%. So right now, what that calls for is a reconfiguration of the whole monetary policy structure, and also to avoid, vigorous rate cuts to try and maintain this new targets in terms of of monetary policy. And then also, if you then look at the way the banking sector has been configured, ideally we would want banks to link their the loans you give to people out there to the prime rate, to the repo rate, and also should be above what they would get when they're borrowing money from the central bank. But in this case, we have a discount window, which is usually just a touch below the repo rate, and then we have the repo rate, and then we have the prime plus prime plus some prime plus premium rate. Right. So what that now creates is a huge spread for profits amongst the bankers, and I think that's what the Reserve Bank is also trying to just rein in terms of how much money can banks make if they had to borrow the money that they lend out.
What is the relationship or difference between the repo rate set by SARB and the prime lending rate that is actually set by commercial banks? Is there a relationship or a differentiation of the two? Differentiation.
So the repo rate was something we call the it's something we call, it's sometimes called the policy rate, right? But it is this rate at which the central bank would lend money to commercial banks. What then commercial banks would do is they would then take that rate plus a premium so that they are able to make money out of that borrowing. So now that's the difference. So when they give you at the repo rate plus at prime plus as a premium, that means they also need to make money somewhere within that space. So right now, what this is going to bring into the fore is you are going to now look at interest that would be pegged to the repo, and then probably we're going to have a focus on the discount window. That is what the banks will be using to borrow from the central bank, and then once the Reserve Bank or the central bank issues the repo rate, now that you will know that that is your interest rate that you're going to have to pay, instead of then having to wait for the banks to give you what their prime lending rate is going to be.
If you could localize it for us, Mr. Sibiya, South Africa and Eswatini were both part of the common monetary area. Could a shift from prime to repo as a benchmark in South Africa have any direct or indirect implications when you look at Eswatini's banking sector?
Definitely it will, not Sile, because number one, you've rightly pointed out that Eswatini is part of the common monetary area. So that does require us to have synchronized monetary policy and financial sector policies therein, right? And also you want the transmission mechanism of monetary policy to be relatively the same across South Africa and also in Eswatini. So if South Africa shifts to the repo rate system, what that is going to do is going to make monetary policy relatively faster to impact the South African economy, rather than through the repo, through the prime rate channel. So you kind of want to synchronize that. So we should expect that should the SARB go with this route, Eswatini should also likely follow the same route. And also, given the fact that we are so integrated to South Africa, if you look at our banks, like 3 over 5 of them are headquartered in South Africa. So such a shift in South Africa will likely result to a shift in Eswatini to maintain stability of the overall financial system and the payment switches and all of those things. So we should expect to see a certain shift and the similar shift coming into Eswatini.
Mr. Sibiya, thank you very much for that one. We look forward to tackling markets with you later on the program. But for now, thank you. That was in-house economist Sanele Sibiya sharing insights on the South African Reserve Bank's proposal of a repo rate over a prime lending rate. Market View continues after this. We're back with the principal statistician in the Ministry of Economic Planning. Stay tuned.